Today in the markets, we had a bit of an update today. A few points on the SPY here, getting close to the resistance channel of the year. Hasn't crossed that other than when it opened on the first trading day up here, 206.88. That's the yearly high. We're getting pretty close there, so that's one thing I'm going to be watching, whether we decide to cross above it or decide to go back down, whether the people buying the stocks are no longer trying to buy and it starts crashing back down towards our support down here. The one really peculiar thing that I found today as the data came out this morning was the trade deficit, which is the largest it's been in almost 3 years, and it missed expectations by 16-17% or so. If that had happened in 1985, the market would have tanked, knowing that the economy is not doing well. We have to import more than we export, so it's not good for us, better for the rest of the world. But the conventional wisdom is that whenever data comes out really bad, that means there's no interest rate hike, there's potentially more printing of money, so markets tend to go high. Most of the macro data over the past few months, pretty much since the end of QE and plus a couple of months prior to that, has not only missed expectations, but it's been awful. And I've gone over that in prior videos. But the peculiar thing I'm watching is the dollar index right now, which today closed at around 93.7, peaked at 95.9. And one thing I'm curious about as this dollar index continues to decline is whether the most crowded trade in the world right now, which is the long dollar trade, is going to not be as crowded as it used to be and start going the other way. Because as the data comes out worse and worse and worse and worse, that means the dollar index is going to go back down and commodities are going to start going back up, which includes oil. And oil had another big update today as a result of the weaker dollar compared to the rest of the world. And one thing about the trade deficit this morning is that I noticed that we started importing a lot more oil in December than we did in November. And as long as the oil price stays around where it is right now, that's going to continue. And as our production capacity decreases because oil is trading so far below profit margins, that means the trade deficit is not going anywhere anytime soon. So what does that mean? A weaker GDP, weaker growth. Today's trade was on Amazon. We said that it was going to go up with a stop at 371, which is a couple points above this resistance of the past couple of days. And lo and behold, this is what happened. We opened a couple points above where we closed. Alright, so I'm in here for $1.99. $1.99 on the 365 put right there, and it just immediately starts going the other way. So I think, okay, maybe it's going to retrace, go up, do a zigzag, and come back down, similar to what Tesla did the other day. There's our stop, and it does that, and we're stuttering a little bit, and then boom. And then boom, we're out. Bad loss. Out for $1.20. 40% loss. And of course the rest of the day kept going up the whole day. Up to the point you can't even see it on the chart anymore. Here we go. Alright, so that was our trade that we were watching. Took a loss. Go back to the drawing board, and what did we do wrong? Alright, the big thing for me, looking at this in retrospect, is that instead of going up or going down immediately and assuming this is going to be resistance, wait for it to be resistance, in the sense that the better trade would have been if it crosses above here, continue to go up, as this thing is in a breakout and it paused yesterday. So after that pause, more than likely it's gonna go up, because once you're in a breakout, it's pretty obvious when it stops, because it drastically goes the other way. So the better trade next time is going to be a cross above that, and then we go up, instead of just hoping it's going to go down on a 50-50 shot. Now, if you really want to do the 50-50 shot, in the sense that, okay, maybe this is resistance, maybe it's not resistance, if you think about it, if it turns out to be resistance, you'll win a lot more than 40%. Because if this thing tanks, you get in where we did at 367.5 is where I got in for $1.99. If this thing goes the other way 5 points, you're doubling your money. But instead it went 5 points the other way and we took a 40% loss. So we go down, we make 100%, we go up, we lose 40%. And then flip a coin, heads you go up, tails you go down. If you really want to do that, you can do that. Me personally, I'd rather know where the heck the thing's going before I just decide to throw my money and hope and pray. But the other two that I was looking at were Google. Oh, that is not. Here's the chart. Before yesterday, I said it was going to go down. Went in and went down at the very beginning. Get out. That was a break even for me. So no money, no gain, no loss. But the other one I said was to look at was Alibaba, and that one more than made up for the 40%. Chart before yesterday. Spread this out. This is the big drop after earnings. Started to go up, and this is one I probably should have done instead, because there was actually a real technical reason for me to get in, as opposed to just, well, I think this might happen. So here's what ended up going on today. Wow. And that more than made up for the 40, believe it or not. And here's what the minute chart looked like, and that's what I was looking at most of the day. Even if you had got out right here, it's still more than 40%. So in the end, had you done all three, would have made some. But the bottom line is that when you're putting money on these trades, your goal is to do one of two things. Your goal is to either win or learn. You don't want to do something stupid like I did on Facebook 2 or 3 days ago. But that's the bottom line when I'm doing this. You either win, which is for me more than half the time, or you learn, so that you don't do something again. And the smidgen of times where you don't win or learn, it's because the market on a rare occasion does something absolutely outlandish, which does happen, and it's unfortunate when it does, but if you're on the right side of that, you make a lot of money. That's why I'm trading. That's why I personally trade options, because if you're doing a stock, you're going down, you make, up, you lose the exact same amount. But with the option, you know it's in a breakout, you know it's gonna move. Every time I lose one of these like this, I go back and I practice some old data, and I practice the days, which is what this chart of Google was right now. So when I take a bad loss, what I usually do is go back to the drawing board and make sure what I'm doing is correct. And the way I do that is I have a software product that allows me to go back and back test real data. So I'll go in and say, okay, if I see this chart, what's it going to do? And then I can go to the minute chart and play it through minute by minute, like I've done back here on this particular day, and draw it out, draw your supports, draw your resistances, draw your stop losses, and trade that way until you get it right. And then once you get it right, go back in and you'll make some. I know I'm trying to put a positive spin on a negative day, but in the end, if all you're doing is focusing on the losses and not congratulating the gains, then you're never gonna make it. You're never gonna make it. You gotta celebrate the wins and learn from the losses. That's all. That's all you can do. And the people that stay in this the longest are not the people that win all the time. It's the people that know what to do after they take a loss. Because nobody gets out of here making 100% of the time. No, very rarely. I doubt anybody even makes it 90% of the time winning. But when they lose, they don't lose a lot. They know when to get out, and they know to regroup and get back in. Because I know plenty of people who were trading at the beginning of the NASDAQ bubble back in 2000, back in the late 90s, right here, after you had this big run in the NASDAQ with the tech companies, all the way up here, all the way up here. What I know a lot of people did is they would sell naked puts. And the reason they're doing that is because the general public at this time had never seen a stock market move this far up this fast, or at least an index like the S&P or the Dow. Because the last time it moved like this was back in the 20s, when you had the roaring 20s, and then it all came to a crash in 1929. But when you have moves like this on a daily basis all the way up, what a lot of people did is they end up selling a naked put. And what is that? What that means is you would basically think that, okay, after this thing moved above 3,300, there's no way it's coming back down to 3,300, because look at it, it's going all the way up. So what they do is they take, for example, if this was an index or a stock, they'd say, okay, here's 3,200. I'll sell a 3,200 put, or I'll sell a 3,300 put. So what that means is that when you open a position to sell, that means you're getting a credit from your broker, and you can't spend that money until the option expires. But if you have a put and the strike is 3,300, and at an expiration it's out of the money, which in this case is above the strike, that means that that put is going to expire worthless. So if I sell a put for $100 and then that put expires worthless, that means I get to keep the $100. But if it goes the wrong way, you're in a heap of trouble. But this is what happened all the way up through, kept going up. People are selling naked puts, making money, just going bullish the whole stinking way up here. The public's on a big craze. They're all watching CNBC. It's the only financial network out there. Everybody's got some money in the markets. The general public is in on the bubble. We go up. We continue to go up, and we peak in March right here, I believe. Yep, right there at 54 something, or at around 5,000. So after it gets to 5,000, people say, okay, well, I'll sell my put at a strike of 5,000. There's no way it's going to get below it. Look at what happened. It's gone up and it hasn't gone back down. This is the new normal, per se. Well, look what happens next. This thing continues to crater. And the thing is, if you assume that the NASDAQ was a stock of some sort, and you bought a put you sold a put to open a position for 5,000, if this thing closes at 4,500 right here, you owe the broker. So unless you sold that put for more than the difference between the strike and where it expired, that's the money you owe the broker. And a lot of people got margin calls, and that's the last thing you want, is a call from your broker saying we need X amount of money because your account is busted. And that's a lot. That's what happened. People lost their millions, and it'll go back up. It always has. It always has, and it never happened. And that's a story of people who don't take a loss the right way. They just continue to make money at nearly flawlessly, and then all of a sudden it goes the wrong way. They continue to do it, and then they get get margin called. You don't want that to happen, so just learn from the losses, and if you need more practice, go back and back test. There's years and years and years of data. You can go back and look at it, make sure your formulas are right, make sure your strategies are correct, and go and make it happen. For tomorrow's trade, I'm looking for something that's at a peak, in the sense that I don't believe this thing's going to make it above the resistance channel. However, that's mostly dependent on the jobs number, which is going to come out about an hour before the market's open. But given that, I'm going to look at a few of these. But three that caught my eye were Google, Apple, and Facebook. All three of these, and all for the same reason, because the trading range of today was less than 1% of the price of the stock. All these trading ranges today are incredibly small and on incredibly low volume. And these are very widely traded stocks, which means all three of these are probably due for a big move tomorrow. Of the three, I'm going to look at Apple. But before I look at that, just a quick synopsis on how I would trade all these guys. I would look at Google, and what I would do is I would go bearish on Google with a stop right here. It's been in a downtrend. Doesn't look like it's gonna stop that anytime soon, but if it crosses above there, then that would be my stop. Facebook's a little different, given that we've got a support line down here that it hasn't wanted to cross. It's on its way up. Not sure if it's gonna reverse back down or not. So what I would do is I would take the high and the low of today, whichever one it crosses first, go that direction. That's how I would trade those. But the one I'm focused on today is Apple. Always hesitant to go bearish on Apple because it's one of the few that have the fundamentals that actually support the price that it's at, given that the last two earnings reports have both been increased profits, increased revenue, increased sales, increased cash flow. All that is positive. But it's having trouble making it above this 120 mark. It tried this over here and then tanked, and then it tried it again, touched it, went down, touched it, went down. And the way I'm looking at Apple is I'm looking like this. I'm looking at support channel right there, or support channel right here, but that one's already crossed, so that doesn't matter anymore. If you really want a more aggressive channel, support one right here. There's not really a correction and an extension or anything like that, or any sort of technical pattern. It's been in this mono wave for quite a while. Tomorrow the support channels are both around the 120 range. Here's the all-time high right here. It touched 120 here and back, and almost back there. But if it goes above this high, I would switch to bullish and take back your profits. It is Friday, so don't stay in forever. Maybe a mono wave or two, if that. But Apple's doesn't have very expensive options. So what I'm gonna do is get out of the trade, as opposed to the LinkedIn trade that I made last week, where I just kept it and held it on. Splits are really tight. Volatility doesn't really keep the bid-ask spread from going too far, which means that if it goes the wrong way, you can get out and still make enough back on the option that it's worth taking the commission for. And more, like I said, more often than not, if it goes the wrong way that we want and starts going bullish, I'm gonna get out, and I'll most likely get out depending on the technical pattern of the day. If it crosses, let's call it the 120.75, because if it crosses that, it's definitely not in a bearish pattern, although it may touch it and come down. But that's how I'm going to trade it tomorrow. I'm going to go bearish with a stop at 120.75. Of course, that's all dependent on what happens where it opens, the jobs number, and all that. So that's how I'm going to do it. Good luck tomorrow.